All right, let's get right into it. If you're a Canadian business owner, you know that getting the right equipment is everything. It's the key to growth. But that leads to the big question. How do you get that new truck, that CNC machine, or that fancy pizza oven without completely torching your cash reserves? Well, today, we are breaking down the ultimate strategic playbook for equipment financing.
So, here's what we're going to cover. We'll kick things off with the big why, the whole cash flow dilemma. Then we'll unpack the two main roads you can take, loans versus leases. After that, we'll dive into the huge tax advantages that, honestly, a lot of people miss. We'll explore the different flavors of leases, and then we'll wrap it all up with a step-by-step playbook to help you get that yes from a lender.
Okay, first things first. You know you need that new piece of gear. It's going to let you work faster, take on bigger contracts, and actually grow your business. But that stuff is expensive. And that right there is the classic cash flow catch-22 that every single business owner runs into.
And that naturally leads to the number one question I always hear. Look, I've got the cash sitting in the bank. Why on earth would I take on debt to buy this thing? And you know what? It's a totally fair question. The answer, though, isn't about debt. It's about being smart with risk and opportunity.
This quote from BDC just hits the nail on the head. It completely reframes the conversation. The point isn't just whether you can afford the machine, it's about protecting your working capital. I mean, that cash is the lifeblood of your business, right? It's what you use for payroll, for inventory, for grabbing that unexpected opportunity that pops up. When you tie all of that up in one single asset, you're taking a massive, massive risk.
So let's say you agree. Financing is the smart play. Now you're standing at a fork in the road. You've got two main choices, and it all boils down to answering one simple question for yourself. Do I want to own this thing, or do I just want to use it? Really, it's a choice between building equity and having maximum flexibility.
And this really shows you the core difference. A loan is exactly what you think it is. The end goal is ownership. You're buying it over time. A lease, on the other hand, is all about usage. You can think of it like a long-term rental, where you're just paying to use the equipment during its most productive years. And trust me, understanding that one distinction is the key to everything else we're going to talk about.
So the biggest win with a loan is equity, plain and simple. When that contract is up and the payments are done, that piece of equipment is 100% yours. It's on your company's balance sheet as an asset from day one, which can actually make your business look stronger on paper. This is the perfect route for things that are built to last for years and years, like heavy machinery.
Now, let's flip the coin and look at leasing. With a lease, the name of the game is all about flexibility and cash flow. Since you're not paying to buy the whole thing, your monthly payments are usually a lot lower. This is an absolute no-brainer for any kind of technology that evolves fast. You avoid ever getting stuck with outdated gear. And, maybe the best part, a lot of the time the leasing company is the one who has to deal with the headaches of maintenance, not you.
Okay, now we're getting to a topic that is a genuine game changer for so many businesses. Taxes. I know, but trust me, this isn't the boring part. The choice you make here can have a massive impact on your bottom line. And leasing, well, leasing often has a powerful, hidden superpower. Just look at that number, 100%. So what does that mean? In Canada, lease payments are generally considered an operating expense for your business. That means, in many cases, they are 100% tax deductible. This is a totally different ballgame from a loan, where you can only deduct the interest portion of your payment.
Let's look at this side by side. With a lease, you can write off the whole payment, the principal and the interest. With a loan, it's just the interest. And think about sales tax. With a loan, you have to pay that big GST or HST bill all at once, up front. But with a lease, you're just paying it in little bits with each monthly payment. This makes claiming back your input tax credits way easier on your cash flow.
Okay, so maybe at this point you're thinking, wow, leasing sounds pretty great. And you're right, the flexibility and the tax benefits are awesome. But it's not quite that simple, because not all leases are created equal. There are really two main flavors, and the right one for you depends entirely on what your long-term plan is for that equipment.
First up, we have the finance lease, which you'll also hear called a capital lease. The easiest way to think of this is like a lease-to-own arrangement. You get the structure and benefits of a lease, but the plan from day one is that you're going to own that equipment at the end. You'll often see these with a buyout price of just $1.
So, when does this make sense? How do you know if a finance lease is the right move for your business? Well, it all comes down to the nature of the equipment you're getting. Here's your checklist. If the equipment is built like a tank and has a super long life, if the technology isn't going to be outdated in a couple of years, if you are absolutely positive you want to own this thing for the long haul, and if you're comfortable handling all the maintenance yourself, if you're nodding yes to all those, a finance lease is probably your best bet.
Now, on the other side of the coin is the operating lease. This is pure usage. Think of it as a true rental agreement. There's no intention of ownership at all. You are simply paying for access to the equipment during its most productive and effective years. No strings attached.
So who is this for? What kind of business or what kind of equipment is a perfect match for an operating lease? Well, the answer really lies in two words: speed and change.
An operating lease is the go-to strategy for any industry that moves at lightning speed. If you're dealing with computers, specialized software, or any kind of tech that needs to be upgraded constantly just to stay competitive, this is your move. You get those lower monthly payments, you completely avoid the risk of getting stuck with an obsolete paperweight, and very often the leasing company is on the hook for maintenance.
All right, you get the why. You've chosen your path, whether it's a loan, a finance lease, or an operating lease. Now we're at the final and most crucial part. How do you actually get approved? Let's build your application playbook right now.
We can break this whole process down into 3 really simple phases. First, prepare your profile. Second, document your business. And third, make your case. I'm telling you, getting organized right here at the beginning is the single best thing you can do to make this whole process faster and smoother. So step 1 is all about understanding what the lenders are actually looking for. And I've got some great news for you. In Canada, a lot of equipment financing is asset-based. That means the lender isn't just looking at your company's bank statements, they're also looking very closely at the value of the equipment you're trying to buy.
Here are the key things they'll check. Yeah, your personal credit score is important. A score over 600 is usually a good starting point. They'll look at your debt levels and how long you've been in business. But, and this is crucial, if you're buying a high-quality piece of equipment that holds its value well, that can make your entire application so much stronger. The asset itself does a lot of the heavy lifting.
Step 2 is just about getting your ducks in a row. Do yourself a massive favor and get this package of documents ready before you even apply. You'll need the formal quote from the seller, about 3 to 6 months of your business bank statements, a couple years of your financial statements and tax returns, and of course your government ID. That's pretty much the core package every lender is going to ask for.
And that brings us to our final thought, and honestly, it's the most important takeaway from this whole thing. Lenders are not just financing a piece of metal. They are financing your ability to earn money with that piece of metal. Your application is not just a bunch of numbers. It's a story. And if you can tell a clear, simple story about how this new asset is going to help you generate more revenue and grow your business, well, that's the most powerful tool you have to get to yes.